cardinal rule number one is when you're in an equity business, listen to the bond guys. The bond guys never listen to the equity guys. But, if you're like a Gene Munster, you really pay attention to what the debt side looks like as you look at your area. Gene Munster's area for decades, Piper Jaffray, and now on his own. Gene Munster really looking at technology. Gene, Robert Schiffman of Bloomberg Intelligence said, look, Microsoft's a AAA. Apple's just below that. Microsoft could do $20 billion debt offering right now and not, affect anything at all. Do we have any understanding of their free cash flow? And Gene, one idea here on their free cash flow, Apple's retired 39% of their shares in the last decade. Do we understand their profit?
I don't think so, Tom. When you think of the free cash flow with Apple, we're talking $50 to $60 billion per year. That's free cash flow. When they talk about their current cash position, call it roughly $75 billion. I mean, they've continued to try to whittle that down, return that to investors. Welcome Meta to that conversation regarding returning capital. But Apple is unique in that it is, it's mind-boggling. If you look at the past year, revenue has basically been down 2.5%, but they've generated, call it $60 billion in free cash flow. And I think it just speaks to the strength of their margins.
Paul, I put this out last night in preparation for Gene Munster that I'm just had it with this sophomoric growthiness study of the media, and it's about the profit. And as Gene mentions, Paul, Zuckerberg gets the 2023 trophy. The way he has shifted Facebook to a profit juggernaut is jaw-dropping.
It really is, and the stock got rewarded for it, too, more than doubling here. Hey, Gene, so last night, busy night for you and busy night for tech investors, Apple, Amazon, Meta. I want to start with Apple here, because for me, and I think for a lot of investors, it's very much about China here, and I'm not sure I heard anything from Cupertino last night that makes me feel more comfortable about what's happening in China. My concern is maybe the consumer's moving away from Western products in general, and maybe Apple in particular. How do you think about China?
China hit the wall. It was down 13% year over year. It was down 2.5% year over year in the September quarter. So we saw that deceleration. The macro has definitely impacted that. If you look at broader Apple business, it was up 10% in Europe, 15% in Japan, 2%. So if you think about what's going on at Apple, it really can be zeroed into the weakness in China. China's 20% of their business. And then the question comes to, what does China look like going forward? And I think the answer is to continue to expect it to be down kind of this 10, 15% for the next few quarters. There is the question, is this just a macro issue related to China? Or to your point, is there just a structural shift away from Western products and Apple in particular? And what we saw was some conflicting data. We saw the China business being down like we talked about, but we also saw that Apple, in terms of its market share, IDC, reputable source, said that that the iPhone is now the best-selling smartphone in China for the first time in the December quarter. And so I think the answer is this is more about the macro. I do want to put one just slightly finer point on this. There is a dynamic of what's going on with the government and their commentary about buying Apple products. Now, if you look at the number of government employees, this basically can create about a 3% headwind to China's business. It's not a formal policy to avoid Apple products. It's been this informal kind of wink and nod. But I think that probably plays into all this too. When you roll it all together, I still think China's a big opportunity for Apple. India is becoming a bigger opportunity too. And I think that this storm will pass.
Yeah, and that's kind of, I think, the message we heard from Tim Cook. I think he's probably taken a little bit more of a longer view. All right, let's switch to Meta. You mentioned that, and just what a story here. I mean, Zuckerberg gets a lot of criticism, and he obviously was on the Hill again recently. But boy, did they turn this company around in the last 18 months. It was, since its inception, it was a top-line growth story. And then he wisely focused on costs and profitability. And boy, that's paid off for the company. What's your view there on Meta?
The cost that's nice. Absolutely has paid off. I think there's a bigger dynamic playing out here, which is just related to their demand. And they had their revenue was up 25% year over year in the December quarter. They guided, you got to go to the high end of their guidance range because they're probably going to exceed that, would imply an acceleration to 30%. Their price per ad was up 2% year over year. A year ago, their price per ad was down 22%. Yep. So that's outside of the whole expense control. The ad market is better, but there's something, the bigger thing going on is that their products people want. I mean, that's the maybe optimistic way to say it. The more skeptic way to say it is they're addictive. Deepwater does own Meta. This is something that I struggle with. But we saw it in the numbers, in the engagement. It's playing through to the revenue. One just other quick thought on the engagement number here. Their DAUs, this is a metric they're no longer going to give, daily active users, but that was 2.1 billion for Facebook. That was up 6% year over year. It's an acceleration over the past few quarters. Remarkable testimony to how people say they don't want social, but they spend all their time.
Yeah, well, the daily average use of Instagram in the Keene household is incalculable. You can't do that number. Gene, here's the real world. It's owned by portfolios. NASDAQ's up 1% right now. And we're going to pick on our good friend Will Danoff up in Boston. He's been doing this for a few years at a shop called Fidelity. It's his largest holding. It's grown out where Meta, Facebook, is 12.x% of Will Danoff's contra fund. But he's probably under-owned it as well. Just the share price today moves contra fund 2% off the leap in Meta. Are these stocks under-owned by institutional Wall Street?
I think Meta is. I think there's still some controversy around just what is ultimately, what does their advertising business look like? I think there's concern about regulation related to it. If you look at the multiple relative to the other big tech companies, it still trades at a discount. So it's going to be, I bet the earnings go up by more than 20% today. The stock up 18% in pre-market, I bet earnings go up. So I think the multiple probably is actually surprising and to stay in that low 20 range where you look at the rest of big tech kind of loosely in the low 30 range. And so based on that, I don't think this is over-owned. And I think that there's, there's room to go. I think this should trade in line with the rest of larger tech. Okay,
so they're $3 trillion. An Uber bull like Dan Ives is what Paul? $4 trillion, $5 trillion. Sure. Add it up, Gene Munster, and someday these four stocks, the Magnificent Four, whatever, NVIDIA, I'm not there yet. I know Gene is, I'm not there yet. But Gene, they're going to have an all-in value of, say, $15 trillion. Are they like the Rockefellers, Standard Oil, Ida Tarbell of 120 years ago, where there's going to be a primal cry, they're too big? Are we getting there quickly?
I think we were there 3 years ago. And I think that, this is lessons learned from the past here, just about can things keep going, about bubbles. There was the everything bubble a couple years ago, obviously what happened in 2000. So I'm skeptic. I want to be just cautious, like, can this keep going? But just the case that I think these will continue to get going. It is as simple as artificial intelligence. I think that this is something that now Apple has stepped into the game. That is as much of the rancor that goes on Capitol Hill related to large cap tech. I think lawmakers understand that these companies, having strong domestic companies that are building AI, I think they understand the importance of that from a national security standpoint. And so I think that there'll be always talk of regulation, but I think these companies will continue to get bigger.
Are you watching UNC Duke this weekend with Vision Pro?
No, I'm going to go old school.
You're going to go old school?
Yeah.
The Zenith with the rabbit ears, right?
A can of Budweiser sitting on the couch.
What Vision Pro, Paul, what would you and I, Lisa, help me here. What would you and I use Vision Pro for?
I don't know. Well, that's kind of where I want to go with Gene here. Gene, where are we? Where is Mark Zuckerberg these days? When you speak to him, when you hear his commentary with the metaverse, that was at best a distraction for this company, and at worst maybe a real suckhole in terms of capital investment. Where are we with that?
I hope we're wrapping it up, but I think the reality is that they're doubling down. And again, mentioned we're investors in Meta. We wish they would essentially pare back what they're doing there. And the simple reason is they had $1 billion in revenue, first quarter of $1 billion in revenue in Reality Labs. They lost $4 billion. They said that the amount of losses annually are going to increase. This is going to be $15 billion plus. This is real numbers, even for these big companies. They're spending a lot. what Apple is showing today with Vision Pro, from a price standpoint, it's 7 times higher. From a technology point, it's probably 30x better. And I think ultimately is that what Meta wants to be, spatial computing, the metaverse for the masses, is that I do believe that will roll out eventually. But I wish that they just wouldn't spend as much. Spend $5 billion a year, not $15 billion a year. But to answer your question, Paul, where are they? They're doubling, tripling down on this, and I kind of see this as BlackBerry versus the iPhone.
Hey, the third company reporting last night, Amazon. Boy, another really good.
I thought they were they were terrible.
Stock's up about 6.5%. Pre-market trading up about 40% over the trailing 12 months here. What did you hear from Amazon last night, Gene?
Well, this one, just in terms of the stock reaction, is a surprise to me. I would, if you'd have given me the press release beforehand, I would have said it's down a few percent. So what we heard last night was that AWS, which is typically the pressure point that people focus on, was up 13%. That compares to 12.5% growth in the September quarter and 12.2% in the June quarter. So we saw, I would say, a 50 basis points acceleration. Compare that to what Google Cloud did. They showed a 320 basis point acceleration to 26%, and Azure 100 basis point acceleration to 30%. Put all this together, AWS should and continue to be the focus for Amazon investors. And in fact, yes, it showed acceleration, but it still is losing share notably. And I think when you fast forward this 6, 12, 24 months from now and think about how these platforms are going to be adding more AI capabilities for the people that use them, I think that advantage Microsoft and Google. So I think it's going to be increasingly competitive. The reason why the stock is up is because they beat operating income by 50%. They crushed it. And this is like the roller coaster game of Amazon and earnings. You get a boom bust cycle for 2 or 3 quarters, and then a boom cycle, and then a bust cycle. And so, Paul, to put it all together, I think Amazon quarter was good. It wasn't great. They got people excited about this Rufus, this assistant shopper. I think it's pretty cool. I think it's going to help engagement, help people find products better on Amazon. Good use of AI. But to me, doesn't justify what's happening with the stock this morning.
All right, let's step back a little bit. Gene, we kind of ran through the big 3 tech names that reported last night. I'd love to get your view here. Now that we've had a little bit of perspective here, 4, 5, 6 quarters where we've had a lot of these companies talking about generative AI, I'd love to get your view as to kind of how you think it kind of really sits as a theme in technology. Is it real? Is it, and how material is it? And how do you play it?
So is it real? Yes. How material is it? The example, my framework is that if you do the scale of 0 to 100, we've talked about this, 0 to 100, 100 being electricity, I would put the smartphone in terms of importance. Electricity is 100, smartphones 25, the internet's 50, and I think generative AI and AI more broadly is 90.
Wow.
I think it is just a step function. And I think we're entering what's going to be a 3 to 5 year bull market that's going to culminate in a bubble. It, by definition, almost has to happen. If this is in fact 90 out of 100, we will see a bubble. So I'm on board that these can be transformative. I mean, we saw Tim Cook finally utter those 2 letters yesterday in the prepared remarks. And I think it's setting Apple up to enter with a foundation model this year. So big picture, I think it's hard to understate how meaningful of a change this is going to be.
Gene, I want you to shift here to long ago and far away when we hung on every word you said at Piper Jaffray about should we be in these stocks. There's a lot of people listening and watching on YouTube and CarPlay who are saying, I'm in this, or I think I'm in it in my 401k, or I'm not in it, and damn, I got to get into it, but I'm scared stiff. I want you to talk the 5-year vision of these companies that have come so far in the last decade. Do you extrapolate out the present trends? Is there a lesser slope, or dare I say, can they even get convexity and accelerate free cash flow, revenue growth, their position within American society?
I think when you look at the kind of scope of where wealth will be created around AI, I generally think of it as in three buckets. I think that there's we'll call it the safe bet. And I think that is this mega cap tech. And I think it's not just own the Magnificent Seven. I think they are, I think the best one, surprisingly, is Google. I think the best opportunity that's underappreciated relative to what's happened with the other ones, I think Google. So this is not investment advice, but from our perspective, we own Google and Meta. And so continue to do that, continue to think that's a great place to be, even with the upside that they've had. But we also believe that AI is going to have a profound impact on companies that are less well known. We have an ETF, the ticker is LOUP. It's a frontier tech, which means that it effectively identifies what are the transformative themes over the next 3 to 5 years. AI is a big part of that. But I think some of these smaller companies that haven't had this tremendous run, I think that's a meaningful opportunity as well. And then the last piece is what we call the ordained late-stage private companies. These are companies like Hugging Face and Databricks and OpenAI, Anthropic. These are companies that are pure play AI companies. And so I want to go back and just answer your question specifically, Tom, is that yes, I think you should continue to own a select companies within the Magnificent Seven, because I think they'll continue to benefit. But as far as trying to get outperformance relative to the market, I think you need to try to search for some of those less well-known sub-$100 billion, we call that small now, sub-$100 billion small tech companies.
I'm long Wayne Labs.
There you go.
Wayne Labs.
Exactly. All right. So, Gene, in your fund here, what are some of the names that you guys own that maybe people don't think about? I mean, everybody's kind of feels like they have their own call on the Apples of the world, the Amazons of the world. Are there parts of the tech space that you think are underappreciated out there?
Yeah, we actually go and look for companies off that beaten path. I mean, there's one company, Nubank, ticker NU, as in November uniform. And Nubank is the fastest growing bank in Latin America. They've basically gone from nothing to about 8% share. Like 1 in 2 people in Brazil use a form of Nubank, but they're using artificial intelligence to help better identify, get the underbanked population to be banked. And it's been a great use case of that, and it works. It works for risk management. So Nubank is a company that we own. Coupang, many of you may not, that may be a new one. Think of this as the Amazon of South Korea, and they basically have a pole position there. South Korea is doing relatively well, and then the last one, Mercado Libre.
Yeah.
I hope both of you are sitting down for this one. Just recently, we spent a lot of time, 7 years working in China, covering these bringing a lot of these companies public, the tech companies in China. We've just in the last few weeks actually made some investments in some Chinese equities, tech equities.
Whoa.
Nice.
I think we'll leave it there. I got to go call my broker. Gene Munster, generous of you to be with us.
Thank you, Gene.